Good morning, good morning. Big Weir, road2roto.com with your morning horn of Z's, your sip of coffee. Another week, another bailout bomb was dropped today. 63 billion in collateral on the last day of the third quarter. 63 billion on top of what they already have out on the 14-day. I'll get to that in a second. Here's the Zero Hedge report. With quarter-end funding needs supposedly squared away thanks to last week's 3 two-week term repo operations, moments ago the New York Fed announced that in the final overnight repo operation of the quarter, dealers submitted 63.5 billion in collateral. Wait, let me say that again. 63.5 billion in collateral. The collateral is completely rehypothecated. Talk about it in the Friday road trip. I go through graphs. I'll show you one of the graphs in a second. But yes, it is intensifying. It is getting worse. It's not getting better. Well, how long have I said it? It is getting worse. It is not getting better. I don't care what the stock market does, the bond market does. The repo market is the bank bailout situation. You're not going to hear it on the mainstream very much. They'll just gloss it over. But every day, huge bailout money is needed. And it's short-term money. They're going to have to implement at some point a very long-term fix like a QE4, but more likely, as the shit starts to hit the fan, a complete bailout. I think it'll be $20 trillion, but they're going to have to go to Congress. That's our moment. That's our time when we can stand up and say, no more banking. No more rehypothecated bullshit, cheating, lying, stealing, bankers go to jail type of situation. All right. In what was the third consecutive undersubscribed repo operation? It was undersubscribed only because they ratcheted the amount up to $75 billion. Now, I'll get to this in a second also. It's no longer fixed at $75 billion. It's a minimum of $75 billion with unlimited sky's the limit on overnights now. I'll show you how that came about. In what was the third consecutive undersubscribed overnight repo operation, yet which saw substantially more participation than Friday's $22 billion operation. And there's a chart for that. Yet those going off by the detail in today's repo operation may have a slightly more rosy take on the funding situation because according to ICAP, the overnight general collateral repo rate surged from almost 1% from 1.85% on Friday to as high as 2.8% on Monday. So not only are they getting a whole lot more money, it's getting more expensive as they bid for it. As quarter-end funding dynamics added to pressure on borrowing costs amid an already tense environment for money markets. Now let me show you where they're getting this data. This is the Federal Reserve Bank of Boston website, the repo and reverse repo operations. They haven't actually posted the reverse repos for today, which is, it should be all of that should be added together because that's a different kind of banker bailout. Because they have to borrow, literally, they're giving the Fed cash for securities. It's just the opposite. And for some reason they need securities. Why would they need securities? They lend them out, they rehypothecate them, there's redemptions, all kinds of reasons. It's a shell game, it's a derivative shell game. But here is the operation. One day. This is a one day for $63.5 billion that the banks needed just for one day, and then they're going to roll it over again the next day at a different amount. Now, when you're diving into this stuff, this again is the Federal Reserve Bank of New York. There's this announcement right here, September 27, 2019. This is that announcement. And it gives you a schedule and parameters of the bailout. I mean the repo operations. I mean the bailout. So as you can see, they did 3 term operations, which means 14 days. Those are all going to expire on October 10th, or by the last one is October 10th, into October 11th, I believe. And then the overnight operations is money just overnight. And you can see from going from back, this chart is from the 24th. It actually started, I think, the 17th of September. After the September 11th chaos within the banking system, then the next Monday they had to go to the Fed and say, help me, help me. I know, it's crazy. I know. So here's the term operations. So, but look, if you look at the bottom, wait, overnight. Here's the overnight for today. They had settlement date. No, that's today's settlement. So this is from last week. Now look what they, after this, look what they posted on September 20th. It's kind of the same schedule, except they took some stuff off, but look what they put as far as the overnight. It used to be up to 75 billion. Now it's at least 75 billion. At least 75 billion. Wednesday, Thursday, Friday, at least 75 billion. And then Monday, going through October 10th, when is the supposedly going to be the end of the 14-day repos, which all that money has to be, all the collateral is returned and all that. Supposedly the world's going to be fixed by the 10th. But look what they put. For each day between now and October 10th, at least $75 billion. And they're saying no term operations, which will be interesting because they don't need it because they increased the cap on the overnight operations to infinity. Over 75 billion means 75 billion or infinity, anything in between. But they're going to have to report it, which is going to be really interesting. So I've done an analysis on the Friday road trip for private road members last week. Here's one of the charts I brought out. This is the repo bailouts cumulative with the 14 days and the overnights. The overnights are not cumulative because they get paid off every night. So this is a chart of the real money that has been borrowed and is currently under contract based on collateral that is completely rehypothecated. Yes, treasury bonds are not what they look like. They are not the safest of collaterals. They are owned by 2 or 3 people in the banking side, and they don't know what to do about it. That's why all this doubt, fear, uncertainty, and doubt has come about. So here, since September 11th, you can see a clear in the linear graph. You can see clearly they are booming. Absolutely. And this money is absolutely necessary on their books, or they will go insolvent. So they keep getting cash bailouts, throwing up shitty collateral, just like in the mortgage-backed security days. And except this is, the treasury bonds are not sound. That's the real scary thing. Supposedly the safest investment on planet Earth has been rehypothecated by the derivatives. And yes, this is the implosion of the derivative bubble. This is what happens. So on the private road, I go to a exponential graph, and it gets scary, as you might imagine. But here's where we are right now. This will get a lot more interesting as we get closer and closer to the date that supposedly the 14 days are expired. Because a big chunk of these, I mean, we're up to over $200 billion worth of bailouts right now on the books at the banks with collateral that they, as of the 14th, they got to pay it all back and then figure out what they're going to do from there. But this is going to get, as of the 10th of October, when the last 14-day ends. What's going to happen? Get on the road to Ruta. Follow the road to Ruta and you will find out. Another interesting thing is Zero Hedge is narrowing down who is demanding all these repos. And because a lot of people thought it was Deutsche Bank, and according to the Fed data, you can kind of get close to who it is. This is the assets and liabilities of the commercial banks in the U.S. You can get close to who is having the problem. And I think next week they're going to have the solution. They've narrowed it down. It is not Deutsche Bank. It's not a European bank at all. It is a U.S., large U.S. institution, or maybe even a couple of them. Remember there, and then you go back and you can go to the OCC data, Office of the Comptroller of Currencies, and look at the derivatives on, for example, interest rate derivatives, which is the largest, which would include the U.S. bonds. And who are the big ones? J.P. Morgan, Citibank, Goldman Sachs, Bank of America. I think it's J.P. Morgan or Citi or both or all of them, and the other thing is they know now that these the treasury bonds and all the real sound assets are rehypothecated in the derivative market. Massive problem with that. Just like the shares of stock, just like cryptos. They have multiple owners for the individual assets on the exchanges. They have multiple owners of U.S. Treasury bonds within banks. Citibank and J.P. Morgan own the same bond and both are pledging the same bond as collateral. It's a complete cluster. And that's how the system falls apart. For more information, go to roadtoruta.com and sign up today. Subscribe right here, and you will get everything, and including the coolest silver coin ever made, and 100 Theta coins and 500 Theta fuels. You will be in the crypto game even if you don't even know how to do it, because it gets shipped to your front door. Anyway, it's Big Weir, roadtoruta.com. The saga continues. I'll talk to you later.